For tax purposes, a farming business isn't about the vibe, it's about what you do. If you cultivate, operate, or manage a farm or fishery for profit, you're generally in a farming business. Entity type doesn't change that definition. On the EA exam, they love wording like manages a farm for profit because that points you toward farm reporting rules. So what counts as a farm? Think production. Growing crops like grains, beans, cotton, flowers, vegetables, even industrial hemp. Raising animals, dairy for long-term milk production. Fisheries raising fish or shellfish for sale. Even niche areas show up in IRS examples, like silkworms for silk, fur-bearing animals for pelts, and beekeeping for honey and beeswax. If the activity is producing agricultural products, it usually smells like Schedule F. Here's the reporting anchor. A sole proprietor farming business reports profit or loss on Schedule F. Schedule C is for non-farm trades or businesses. The exam trick is when something is farm adjacent, but not actually farming. If you're not cultivating or raising the product, you may be Schedule C even if your customers are farmers. Common non-farm examples: veterinarians, businesses that only provide farm labor or equipment, sellers of farm supplies like pesticides and herbicides, agricultural service providers who prep soil or fertilize but don't actually farm the land. And a big one, businesses that are only in the business of breeding, especially household pets like dogs and cats. On the EA exam, breeding alone is a red flag for Schedule C, not Schedule F. Even when you have a farming business, not every dollar connected to it is farm income. Wages as a farm employee aren't farm business income. Income under a grain harvesting contract where you furnish workers and machines doesn't count as farm income. Gains from selling farmland or depreciable farm equipment aren't farm income either. And passive rental income from farmland, when the owner doesn't materially participate, is also not farm income. That's a favorite exam distinction. A quick way to stay sane: ask 2 questions. First, is the activity farming, meaning production and management of a farm or fishery for profit? If yes, think Schedule F for a sole proprietor. Second, is this specific income item actually farm income, or is it wages, passive rent, or a capital gain from selling land or equipment? On the EA exam, separating farm business from farm income is where points are hiding. Which of the following types of business income would not be subject to self-employment tax? Here are the choices: fees received for services performed as a notary public, profits from a sole proprietorship, rental income from renting personal property like equipment, or a general partner's distributive share of partnership income. Think about it. The correct answer is fees received for services performed as a notary public. It's reported with business income, but it's specifically excluded from self-employment tax under the Schedule SE instructions. A tempting wrong answer is rental income from personal property, because rent sounds passive. But renting equipment can be treated as a business activity and may be subject to SE tax depending on the facts. Summit Horizon Media Incorporated is a C corporation with publicly traded shares. During the year, it issued 1,000 shares of treasury stock, sold on the open market. Amount received was $205,000. Issuance costs were $13,000. Par value was $22,000. What gain does the corporation recognize? $170,000, $183,000, $205,000, or zero? Think about it. The correct answer is zero. A corporation does not recognize gain or loss on the issuance or sale of its own stock, including treasury stock. The issuance costs don't create a deductible loss either. They're capital in nature. The tempting wrong choice is $183,000, which is proceeds minus issuance costs, but the tax rule overrides that math for a corporation's own stock.